Hi, my name is James Robinson, and this is my stock pick of the week. My goal every week on this blog is to find a company that is both an excellent company and one that's currently undervalued. My definition of an excellent company is one which has either a durable competitive advantage or provides extremely good returns on invested capital. My stock pick for this week is a company called Argan, A-R-G-A-N, Argan Inc. Its symbol is AGX. Argan provides services to the power generation and renewable energy industries in the form of engineering, procurement, construction, commissioning, operations management, development, and technical consulting services. In the renewable or alternate energy sector, they have completed 44 projects, totaling 14,000 megawatts of power. To put that in perspective, that's enough power that's enough energy to power 14,000 homes, which is the equivalent of Muncie, Indiana, or Santa Fe, New Mexico. The firm has 1,550 employees. It's based out of Rockville, Maryland. The firm was founded in 1961. It owns 4 major subsidiaries with offices in Connecticut, North Carolina, Ireland, and Maryland. The company is a small cap and went public in 1995. As of February 22nd, 2019, it had a market cap of $726 million, revenues of $564 million, profits of $61 million, its PE ratio was 11.96, its yield is 2.13, and it has 0 debt. To recap, when I look at a company, I look at 29 different areas in terms of their financial strength of the company. 9 of those areas are operating issues, 10 of those areas are financial issues, and 10 of those areas are management issues. I define management as the company's ability to return and create wealth for its shareholders. Financial is how the company uses money and debt and risk, and operating is how they provide goods and services to their customers. Here you can see the company has excellent scores in all operating, management, and financial categories. Its total grade point average is 3.41. Again, I can grade every company on a scale of 1 to 4, 4 being the best, 1 being the worst. And this company is one of the highest rated companies that I've looked at over the 800 companies that I've looked at. It has exactly one area that I rate as a 1. That's in shares outstanding, and unfortunately the company has issued new shares over the last 10 years as opposed to buying them back, which I like. But other than that, the company does a very solid job. I always start my research with gross margins, and this company's gross margins are inferior. They're frankly a little bit unsatisfactory, and if you didn't look at anything but gross margins, this would be a company that would be pretty easy to rule out. The red line represents the minimum gross margin that I expect, and you can see that they're very low. In fact, closing in on the lowest 10% of companies in terms of gross margins. There's a number of reasons why we can overlook that, but I wanted you to understand that I don't just look at things blindly. I really do look at the whole story to try and figure out what makes sense. By way of illustration, consider that you were looking for a hitter in a baseball team. You're the general manager of a professional baseball team, and you felt that it was important that your player not strike out, right? So you think strikeouts is something which would make a player undesirable to you. So now imagine there's a player with 2,597 strikeouts, the most of all time. That would be a player who, if you think strikeouts tell the whole tale, you would rule that player out and not hire him for your team, not draft him, not trade for him, not get him in free agency. Well, what if that player also managed to hit 563 home runs? What if that player was a 4-time All-Star and an MVP? What if the hitter was a first ballot Hall of Famer and had the nickname of Mr. October for his World Series heroics? So if you look at just strikeouts, then you would be obligated to pass on a guy named Reggie Jackson. Not many teams would do that because you have to look at the whole story. There's more to it than just one single component. So again, Argan had gross margins that are somewhere between disqualifyingly bad and disinteresting. However, here I am telling you by the company why. Because my analysis is not about blindly following a single equation or black box. It's about looking for solid companies. And gross margins notwithstanding, Argan is a great company. So let me see if I can convince you as to why. So first, let's look at the earnings. You can see here that the earnings have gone up significantly year after year after year. And when you see a chart that's going up this fast, that has to make you go, well, what's going on? Why is this company performing so well? The next slide is earnings per share diluted, and you can see that the earnings per share are not going up quite as fast as the earnings. We're going to talk about why that is. But in either case, they're going up dramatically. And since 2009, when the recession ended, this company has done better and better and better year in and year out. And this is the slide which made me think, well, I got to figure out what's going on here and see why this company is earning so much money when it has such low gross margins. So we talked about how its gross margins are unsatisfactory, This is net earnings as a percentage of revenue. Again, you can see that it's in the top 25 of companies in net earnings as a percentage of revenue. So this isn't operating income, this is net earnings. This is for every dollar of income they get, how many dollars reach the bottom line, and this company is in the top 25% year in and year out in that category, and sometimes significantly above that. So now all of a sudden I say, well, maybe they're pretty efficient at getting dollars to the bottom line, even though they're not efficient at getting money from the top line to operating income. So let's explore why that is. I have this concept that there are 5 taxes that a company has. Selling general administrative, plants and equipment, inventory, R&D, and interest expense. Companies have these costs that they have to pay year in and year out. And some companies have significant costs in these categories. And so even though they have really high gross margins, they have these taxes that kind of whittle the money down until not much of it reaches the bottom line. Argan is the opposite. Argan doesn't seem to do a great job of getting money from coming in the door to operating income. But once that happens, they have very little expenses. If you look at SG&A, they're very close to the top 10% of SG&A, and they have been for a very long time. SG&A being selling and general administrative. In terms of plants and equipment, they're in the top 10%. They spend virtually no money on plants and equipment. So these 2 slides are a couple of the reasons why I'm willing to overlook the relatively anemic gross margins. Again, in inventory, they have 0 inventory. So that's no money that's being lost to shrinkage, no money that's being lost to money that you have to hold and tie up to buy inventory. So that's great. And R&D, they are spending no money in R&D. So those are 2 issues that where other companies are spending a lot of money. Apple and pharmaceutical companies spend tremendous amounts of money in R&D, and this company doesn't have to spend any. Again, here it is in terms of debt analysis. If you look at the if you look at the red line, you'll see the total amount of long-term debt the company has, and you'll see that it's effectively 0, and it's always been 0. So this company's paying no money in interest. The blue line, which is total current liabilities, is going up, but it's going up, frankly, slower than profits. And again, total liabilities are things like your rental obligations and money that you have to pay this year. So it's really costs of being in business. And those costs are going to go up as you make more and more money. This is not a sign of a company that's taking on debt. They have no debt. And the result of having no debt is they pay no interest. And here you can see the interest expense. Again, it's at 0. The goal is that we're spending less than 15% of our gross revenue, of our operating income on interest, and this company spends 0. So of the 5 taxes, they're in the top 10%, sorry, the top 25% in terms of selling and general administrative. They're in the top 1% in terms of R&D. They're in the top 1% in terms of inventory. They're in the top 10% in terms of facilities, and they're in the top 1% in terms of interest expense. And that's why we're able to say, even though they have very, very poor gross margins, they're still a very solid company in terms of returning money to the bottom line. So current assets to current liabilities. You can see here again, current assets have gone up every year, sometimes dramatically since 2011. And they go up at a rate that's faster than the current liabilities. So they're saving money every year. They're buying, they're creating assets which they can use. They have effectively 2 years worth of current liabilities in the bank. You could make the argument here that this company is, if anything, keeping too much money in the current assets and could afford to return even more money to the shareholders. And my hope is that they'll do that. Here's the next chart, dividends. This is how well the company is rewarding the shareholders. And you can see that the dividends have gone up every year since 2011 when they started paying one. Again, there's 1 year where they went down. But basically, they've gone up every year. And so we're really comfortable that this company is starting to make an effort to return money to the shareholders, and they're doing a better and better job every year. So again, when looking at dividends, I don't think it's enough to just say how much money they're paying to shareholders. I think we want to look at that qualitatively, and figure out exactly how likely it is that that can continue. So when we look at dividends, of course, we look at yield and growth. We look at dividend safety in the context of earnings. We look at dividend safety in the context of cash flow. And we look at dividend safety in the context of current debt load. We're not going to worry about debt load because there is no debt load. So there's no worry that interest rates are going to go up and make it impossible to pay a dividend because they have no interest expense. So in terms of yield and growth, the company currently pays a dividend of 2.13%. The S&P average yield is 1.92%, so it's above average. Not tremendously above average, but it's above average. And the average dividend for the last 5 years, the average dividend growth has been 14.9%. So that's excellent. So it's really significantly outpacing inflation in terms of the dividends that it's paying back to us, the shareholders. But dividend safety in the context of earnings. The current payout ratio is 21.7%, so that's very low. That means for every $100 of profit, they're paying $21 in dividend. That leaves 80 cents on the dollar for them to continue to reinvest in the operations of the business. The average payout ratio for the last 5 years is 35.9%. So actually, that number is they're even safer now than they've been average over the last 5 years. I'd like to see them, frankly, get the payout ratio up higher and get it closer to this 35 or 40%. But that's where the number is now, and again, there's no reason to believe this company won't be able to continue to pay its dividends for the foreseeable future. Looked at in terms of cash flow, again, this chart is the last 5 years worth of cash flow. Last year, the cash flow was excellent, and the company only used 6% of that cash flow to pay out dividends. Again, that number seems to me like it's low. They should be paying more. In the last 5 years, they've averaged 35.5% of cash flow to pay dividends. That number is closer to a number that's safer, a number that you should expect. And so I'm comfortable, again, that cash flow is not going to create an issue for these guys to continue to pay their dividends in the long run. So as we discussed, dividend safety in the context of debt load, there is no debt. They pay zero interest, the interest rate is zero, and that means that there's really just no risk that debt's going to be the thing that keeps them from paying a dividend. Well, this is the chart that's troubling to me. This is the shares outstanding, and you can see that since 2010, this company has continued to issue new shares. Not very many, but a few. And I don't really understand why they're doing that. This company makes enough profit to justify not issuing shares. It has the cash flow. It's not borrowed money, so why do they continue to dilute me as an owner, and what are they doing it in favor of? My perception is, my thinking is that this dilution is probably the result of bonuses being paid to top executives. It may also be small acquisitions that they're making. I could dig into it and research it. It's probably not worth it because it's not a tremendous drain. I just would feel much better if they'd gone from 13 million shares outstanding to 12 million shares outstanding, instead of going from 13 million shares outstanding to 15 million shares outstanding. And again, this is over 10 years, so it's not enough of a deal that I would disqualify it, but I'm aware of it. It bums me out. It's something you'd continue to look at and try and keep track of. One real measure of the value of a company is its shareholders' equity. And you can see here, shareholders' equity has just gone up parabolic. I mean, it's fantastic, right? You're just going to own a bigger and bigger company every year. And so this tells me that, again, this company is being run extremely well, and it's being run for this benefit of its shareholders. Even more importantly, here's a look at the company's return on assets. And this is the thing that has made this company a real buy for me. Even though they continue to pile up assets and they continue to pile up equity, they are able to get significant returns on investment. You can see here that they're in the top 10% of companies in terms of return on investment for 3 of the last 5 years, and really the top 25% since 2009. So it's an excellent company in terms of generating equity and generating assets, and then it gets an excellent return on those assets, which makes me really happy as a stockholder that my company is going to be more and more valuable over time. And in theory, that should reflect in stock prices over time. Here you see return on shareholders' equity, and if you look closely at this chart and compare it to the last chart, which is return on assets, you see that the shape of the chart is exactly the same. That's because its equity and its assets is exactly the same because the company has no debt. Again, you can see that it's a little bit lower in terms of return on equity because they're not utilizing any leverage. If they utilize some leverage, they'd have less equity for the same amount of profits, and then the company would be significantly higher and above this 10%. But effectively, in terms of return on equity, they're north of 15% since 2012. I'm very, very happy with that. That's all I need to see. So I have no concerns about this company's return on shareholders' equity. In fact, I think it's excellent, again, considering that there's no debt. So what is Argan's profit, and does it have some sort of consumer monopoly? So it serves a niche, right? Advising power companies, and especially in the construction of new facilities. That's a very small niche. There's not a lot of people that are doing that. They also have experience doing 44 renewable energy, wind, solar plants, and that experience leads them to be more and more desirable and allows them to drive pricing. So because it's a small niche and it requires significant expertise, I think it's fair to say it has a consumer monopoly, but its consumer is a very small universe of people that are either power companies, utilities, or people that are trying to get into that industry through solar farms and wind farms and things like that. And so, again, I think it has sort of a consumer monopoly, but I don't think it has the same type of consumer monopolies as Wrigley or M&M's, Hershey's, things like that. But they are a business that requires very little capital to produce income. It has zero debt, solid management, and because it's able to get high returns on assets and high returns on equity, and it has no debt, I'm able to overlook the fact that it doesn't have the greatest of consumer monopolies and recommend this company. Does the company have pricing power? Again, I think that it does, partially because of its low cost structure and partially because it's in a niche that there's not a lot of people who have the same skills they do. And so I think it's well positioned to out-survive its competition. Does the company have reasonable debt levels? Yeah, it has zero debt. Does the company reward its owners? They're paying an above average dividend and the dividend is rising. They haven't been repurchasing shares, I've talked about that, but they do get an excellent return on equity, return on assets. And so, I think this is a solid company. It's not perfect. I don't think any company is. But I think at this price, 11 times earnings, it's a really good buy. So at $46.69, I would recommend buying this stock. Here you can see a chart of the companies that I've taught you to buy since starting this blog. First was Altria, which is MO. Then it was T. Rowe Price, which is TROW. And finally, this company, Argan, which is AGX. I'm buying shares, about 200 shares of, 203 shares of AGX, of Altria, and 214 shares of Argan. I bought them at the price that they were at when I made the video, which may not be exactly the day it was published, but within a day or two. And you can see that the Argan's gone up pretty nicely, the Altria's gone up pretty nicely, about 5%, and a slight profit for T. Rowe Price. I'm not worried about any of this. I'm not worried about what it does in the first few weeks. Let's really focus on what it does over the first quarter, 6 months, and year. I'm just doing this so we can keep myself honest as to the companies I'm telling you to buy, the prices at which I'm telling you to buy them, and we can sort of track how it's doing over time. There's going to be fluctuations every week, and you notice I don't even have a total here. Probably do a total when I get to 10 stocks. But I just wanted to make sure that every time I do a presentation, we're keeping track of what I've told you going forward, what I've told you leading up to that presentation. Thank you very much for your time.